Warren Buffett, arguably the world's greatest investor, just sold all his S&P 500 holdings, prompting speculation and concern from investors and the media. Is this a warning that the market is going to tank? And more importantly, should you also sell? Let's find out. So what exactly triggered all this? Berkshire Hathaway's recent SEC filings revealed that it has completely sold its Vanguard S&P 500 and SPY ETFs. But does it signal that Buffett is bearish on the S&P 500? If you look closer at Berkshire Hathaway's positions, you'll see that its top holding is Apple stock, worth over $75 billion. This is over 28% of its total portfolio. Even its 15th largest holding, Amazon, is worth over $2 billion, or around 0.82% of its portfolio. Compared to this, its S&P 500 holdings, split between VOO and SPY, were just 0.01% each. Together, they were less than $48 million in a total portfolio of $267 billion. Bottom line, the holdings were totally insignificant to begin with, and this sale is likely just to clean up very small holdings. So what about all the media headlines? As always, they were nothing more than clickbait to grab your attention. But what should you do as an individual investor? Should you continue investing in index funds or follow Warren Buffett's lead? For decades, Buffett has recommended that non-professional investors should put their money into low-cost index funds and hold them for the long term. He believes this is a very reliable approach for wealth creation over time. And this advice holds true even now. Index funds are still a solid choice for individual investors because they offer several key advantages. Investing in an S&P 500-based index fund provides you exposure to 500 large US companies across a broad spectrum of industries. This provides you with significant diversification and eliminates the risks associated with investing in individual stocks. You can achieve this diversification with a very low investment. Even buying just one stock of each company in the S&P 500 would cost tens of thousands of dollars, but you can buy VOO or SPY for under $600 to get the same diversification. One of the greatest advantages of index funds is their simplicity. You don't have to spend any time and effort researching individual companies, and you don't risk losing money chasing winning stocks. Many index funds have very low expense ratios since they don't buy and sell stocks very frequently and don't need to hire research analysts to pick stocks. This means that a larger portion of your investment contributes to the actual growth of your portfolio. Over the long term, the S&P 500 has shown consistent growth despite periodic bear markets and recessions. So investing in an S&P 500 based index fund is a guaranteed avenue for long-term wealth building. Buffett's sale highlights the importance of ignoring market noise, as financial media often overhypes his moves. Individual investors should not let headlines dictate their strategy and stick to tried and true investments like index funds. But investing well is just the beginning. There are other life-changing financial moves you must make. Watch the video on your screen to get ahead of 99% of people in 2025.